Okay, we're recording. This is Saturday, is today the 20th? I'm sorry, March 20th, May. Begin with an M, close enough. March 20th. And this is the asymmetric Saturday regular meeting. Some of you may be new. And if you are, then you know that all of these, sorry about that. All of these meetings are recorded and then archived on the website so that you have access to them later. These are meetings as opposed to just plain old lectures. And what I would expect is that if people wanted to talk or say something, they're free to do that. You can just simply unmute yourself if you want, or you can go to the chat and just type in a question, and I'll answer whatever questions that you have there, or just, if it's not a question, I'll look at it and note it. So today, what I'd like to talk about is a strategy. Oh, someone else is coming in. Let's get this new person in. Today, I'd like to talk about a strategy that I've developed originally for the 0DTE service that I run. But it has applicability to the 3D options and even the advisor newsletter. Now, originally, I developed it for 0DTE because, well, it was kind of more of an experiment. I was unhappy with the original strategy that I took. Now, the 0DTE, for those that don't know, stands for 0 days to expiration. And if you know about options, then you know that every options contract has an expiration date. So, hold on. Hey, y'all, can you close the door? Maybe someday I'll build a soundproof studio around me. Every options contract has an expiration date. So with the 0DTE, we choose to trade on the very last day of expiration. And this is particularly advantageous because when trading the S&P or options on the S&P, either the index or the futures or the SPY, because they have something that's kind of unique to the S&P. They have 3 contracts expiring every week on Monday, Wednesday, and Friday, where most stocks expire only once a month. Some stocks have weekly expirations, so the contracts expire on Fridays. But the S&P has one that expires 3 times every week. And so that provides a unique opportunity, particularly for those people that like to trade often and day trade and maybe live a little bit closer to the fire, to the flame. And the advantage is that, well, there are lots of advantages of, say, selling options. And I talk about that a great deal, that selling options is by far the most profitable way to trade options, and the most consistent way to make profits, because you have huge advantage on your side. One is you have this property of premium decay, which works in your favor from a time perspective. So the longer you are within the profitable area of an option, the more you're actually collecting in premium if you are a net seller or net short of the premium or selling of an option. So in other words, if you have a credit spread, or if you're selling a naked put or a naked call, you're collecting the premium. And the reason for this is that the reason why it's a big advantage is that you don't have to be right about which way the option is going, the price is going, for the most part. So you can be right whether price is staying the same, because as time progresses, you're still collecting, or if price goes in the direction of the spread or the option, because now you're gaining not only in the delta, but also in the theta or the premium collection. And you can even be right if it goes against you to some degree, where you're still collecting the premium. Where if you're long on an option, there's only one way to make money long on an option, and that's to have price move in the direction that you want it to go. So that's an inherent advantage. And the other advantage that you have is that in general, option volatility or implied volatility, which is what premium, the price of premium or the value of premium is based on, is always overstated. Not always, but the majority of time is overstated by the market by 85% of the time. So what that really means is that when you're selling these premiums, 85% of the time, you're selling them overpriced, right? So it's like if you had
you could ask people to mute their phones, please.
you could, you know, routinely overprice all of your products and everybody would buy them, right? So that's the other advantage that you have. Now, most zero DTE practitioners use a singular strategy. And that strategy is taking advantage of this zero DTE or the premium collection thing. But they do it in a particular way that doesn't really take advantage of the time aspect. And because of that, because you're so close to expiration, what they're trying to do is they're trying to create a very high probability trade that would attract a lot of people based on things that they don't really fully understand. They hear high probability and they think, oh, high probability, then I can get in here and this is the trade for me. I can make money very regularly. Now, there's some problems with putting on high probability trades because there's always an inverse relationship between the risk that you take and then the profit that you can collect. So if you're taking very, very little risk, right, then the profit that's available to you will be, well, let me put it the other way around. If the probability, it's a relationship between probability and risk. I'm sorry, I misstated it. So if you enter a trade that has very high probability, then the risk is also very high. Maybe the inverse way to say that is that if there's a very low probability of you losing, then the risk is extremely high. That's probably the best way to say it. If there is a very high probability of you losing or not being profitable, then the risk is very small in general, if you trade the way they're talking about. If you tried to set up an options trade in such a way that you must be in the profitable area of the option at expiration. Now that's, let's see, can you mute everyone, please? Too much background noise. Yeah, everyone is muted. Is anybody else experiencing background noise? Oh, it was a dial-in caller. Oh, okay. Well, if they come on again, then I'll just mute them. So with every option strategy, there's a, how can I say this? There's a profit and loss graph that you can draw that will show, based on what price you're at, whether or not you'll be profitable or not. And spreads have a certain look to them. Iron condors have a different look, etc. And so at expiration, you have this pattern of what things look like. But what most people don't show you is, well, what does it look like before expiration? Now, this is the place where I'd like to see if I could change this and maybe share the screen. And I think I will. I think what I'll do is I will make this full screen like that. And then I'll bring the zoom in front. I see. All right. I think I've discovered a way that I'm going to do this. So, because I really do want to show this. It's kind of, it's hard to just explain this, waving my hands. I just have to rearrange the screen a little bit. Let a few people in. All right. Hold on, have patience. I'll have to do it that way. And what I'll do is I'll close all the other windows so there's no distraction. Thank you for your patience, by the way. I'm almost there. I wish Zoom had not changed the way this works. They've just made it harder for me. All right. So I'm going to share the screen. Basic. Oh. Sharing screen of Ernie's. Oh, so I can choose Windows now. Now it just popped up. I'm very sorry about this. But anyways, okay. So it does work the way I had hoped. All right. So let's say that we wanted to put on a spread for Monday, right? And I'm going to do a put spread. I'm going to say assume that maybe a very low probability trade or high probability trade, which basically means that you have to choose a trade that will very likely be out of the money when it expires. And so from a delta perspective, that means choosing a very small delta. Now, most people will choose a delta that's around 5 or 6. So we'll choose that. And so we're going to choose a bull put credit spread where the short strike is at 38.20 and the long strike is at 38.15. All right. And so we're going to sell a vertical. So there it is down below, 38.20, 38.15, short 38.20, long 38.15, a put credits as 20 cents of credit. Not a lot of credit. So let's take a look at what that looks like from a risk profile point of view. All right, so we got to move this over a little bit. Now you can see the zero profit line is way up here. And the blue line, the cyan line, is the profit at expiration. All right, so you can see that from where the zero crosses the blue, there's very little profit. And if you look down to the lower left, you can actually see the amount of profit in the lower left corner of the graph right here as I scan over it. So the profit at expiration, should price stay above 38.20, is $100. But the profit, if it is less than 38.20, can get as low as $2,400. Now that's for 10 contracts. Let's take that down to just one contract, just so you can, so it's maybe a little bit more realistic for some people. All right, so now for one contract, the profit at expiration, the max profit you can achieve is $10, and then the max risk is $240. That's pretty insane, right? And that's what most people are doing. And then they might add a call spread onto that with the same kind of delta. And so let's add a call spread. We'll do a call spread that is a 5 or a 6 delta. Here's a 6 delta. And so we'll sell a call spread there, and we'll also make that one contract. Going to move it up so you can see it. There we go. So there's our two contracts, a call spread and a put spread. And then we'll look at the risk profile. And you can't see the call spread because it's way over there. Let's bring it in. There it is. So now we have a call spread where the max loss on the wings is $227 on the left and $227 on the right. And the max profit is $22.50. So in other words, I am, my risk is 10 times greater than the max profit. Now, the advantage of this is that, you know, if we start out in the middle here, there's only about a 5% chance that price will move all the way to the right or all the way to the left, making me unprofitable and potentially taking a huge hit. Now, what most of these zero DTE guys do, they recognize that, you know, most people don't want to, you know, I mean, look, you could go and you could maybe win, you know, 10 trades in a row, and maybe only 1 out of 10 or 1 out of 8 trades will actually give you a max loss. But the problem really is that what happens is that you'll see that the purple line represents the actual profit before expiration, or the current profit at that time. And so if you move way over to the left, you could conceivably be losing a lot of money. And then as you get closer and closer to that day, that curve starts filling in and rising and becoming steeper. So you could still be inside the profit tent, but you could be down 6 times, 5 or 6 times what your credit is. And from a person who is trying to manage their money and looking at this, saying that, well, geez, if it moved that far, we're just very, very close to going to max loss. Most people who are trading this, if they start moving too far down here to the left or to the right, will exit that trade. And they'll exit that trade because the heat is just too high for them, right? They don't want to take the chance of not only, you know, just potentially losing 3, 4, 5 times the credit that they were signing up for, because that would wipe out the last 4, 5, 6 trades, right? But potentially going all the way to the max loss and wiping out the last 10 trades, which could be a month or 2 months worth of trading. But this is the strategy that most people are using. And the way they fix that is that they put on what they call a stop. Well, they call it a stop. It's a stop. They put on a stop, and they set their stop at 3 times the credit that they take in. So in this case, the credit that they take in is about $22. So they'll set their stop at about $60, $66, say right here. All right. So if price came all the way down to here, or on the right-hand side came down to here, then they will exit the trade. Now think about this. What they've essentially done is they have squeezed the size of, or the left and right extent of this trade, and they have made it a lower probability trade. Instead of a 95% probability of trade, they've probably made it more like a 65% probability trade, but with none of the benefits of a 65% probability trade, because a 65% probability trade would have way more credit and less risk. And on top of that, if they hit it, they exit the trade, so they take a loss. Where if they had not set the stop and it went down to say $60, and then let's say it came back, they would still be in the trade, right? So they just set these stops because they're scared as shit, which is really what it comes down to. They're scared as shit of losing money. And so they set that stop and they claim that it makes them feel better and that it gives them good performance. And all the performance numbers that you're seeing of people doing 85% are total bullshit because it never happens. They never tell you about the big losses that they have, or when they forgot to put on, the stop, or they ignored the stop or they took it off because they felt like it could come back and then it didn't. This is what they're all doing. And you hear about it all the time. And besides, they don't just stick with this one trade. Let's say they stop out. Well, what are they going to do for the rest of the day? They just go home and say, okay, that's it. We hit our stop and we're going to go home. We'll try again on Wednesday or Friday. They don't do that. They put on another trade. And then they try to make up for the loss, and they don't put the stop, and then they hit a max loss. And they'll just do this over and over. And I've seen it. And I experienced it. I tried making the strategy work, and it just doesn't work. It can work for a little while, but you're fooling yourself, and you're thinking that you're a genius because you won 5 trades in a row, until you lose that 6th trade and you lose a lot of money, and it wipes out the past 3 or 4 trades that you did. And you just feel like you just wasted, 2 weeks of your life trading this strategy. And what happens if you have 2 or 3 of these max losses in a row? You could wipe out 2 or 3 months of your life. So anyways, the zero DTE, while it is appealing because of some of ways that you can create a narrative to make it sound like it's great, is really not so great. And a lot of people are finding this out. So I decided to come up with a different way. I said, there must be a better way where I take very little risk and have the potential to make big profit, right? That way, even if I hit the max loss, it'll be like, I don't care because it's such a small risk. But what if I could also, based on the risk that I put on, achieve some level of success, or profit? Let's say that I don't take it all the way to expiration. Let's say that I only take it to the first hour or two, or in the case of a swing trade, the first day or two, or the first 3 days, and I can recover at least the amount of risk that I put on, maybe more, right? So in other words, I can achieve 100% or maybe 150 or even 200% of the risk. And if it goes all the way and achieves my ultimate goal of being inside the most profitable area, maybe I can make 10 times my risk. At least this way, if I'm wrong, the chances of being wrong are very small. And when I am wrong, the cost is very small. But most of the time, I will be right because of not probability of at expiration, but something that's called probability of touch. Probability of touch is really based on the idea that stock prices are going to fluctuate. There's an average level of volatility of how much it's going to go up or down. And so when it does this volatility dance, it may go up, it may go down. There are times you can kind of predict that there's a greater chance for it to go up than to go down. But if it, let's say it goes up temporarily and then goes not all the way to your ultimate max profit, but let's say it goes a third of the way, and you're only say 10% or 20% into the time that you have for the expiration of that, and you're sitting there with potentially as much profit as you're risking, or maybe even more. So for instance, let's say that your max loss on the trade is $25 and your max gain is $250. And in the first 2 hours of your trade, you're at a point where it's moved far enough into the trade where you're profitable by $25. You've just achieved 100% profit relative to your risk. You could take the trade off right then and there and say, look, I'm making 100% of my money. Now, who doesn't want to do that? Maybe if it keeps on moving and it's moving fast enough, maybe it's a trending day and it moves all the way into your profitable zone, you have the potential of making 10 times your money by being in the $250 profit zone. But if it loses, it's not a big deal. You lost $25. Okay. Now, if you can win enough times with this probability of touch idea, then the losses are going to be of no consequence to you. Of course, losses are always a consequence, but if you win enough, then they aren't. So for instance, if I can win 3 out of 4 times, that means I have 3 winners, 1 loss, then I'm up 2x every time I trade, right? That's a winning strategy. And then with the chance of every once in a while, maybe making more than 2x, maybe I can make 10x. So what I've found is that, this is a great strategy. Now, what would that look like? Well, I'll show you what it would look like. And most people don't even think of doing this, and I'm not sure why. But you could put on instead of doing an out of the money trade, you could put on an in the money trade. I'm sorry, let's see. You could put on an in the money trade where, let's see here. So instead, perhaps I'd say, okay, here we are sitting at 38.95, and I'm looking at the average true range of my of the asset that I'm trading, in this case, the S&P. And I'm saying this darn thing moves 70 points a day, right? Well, let's say that it moved 70 points today. Where would I put the trade? Maybe I'd put the trade at 60 points above where I'm at, right? So if we're at, say, 3,900, let's say I put the trade at, say, 3,950, or maybe even 3,940. All right, I'll put a put spread there, an in the money put spread. And we'll go down to 1 contract. And then we'll look at the risk profile of that. So here's the risk profile of an in the money put spread. My max loss is $25. My max profit potential is $225, almost 10 times what my max loss is. However, when I get into this trade, I may find that I can actually get into it for a little bit less in terms of the cost. If you see the 0 line and then the purple line, there's a little delta there. I might be able to get into this trade for a little bit less than my max loss. And my max loss, I could actually make my max loss as little as $20 or less. All right. So let's say I get in right here, right where price is. Now, if price moves down, the max that I'm going to lose is $25 minus the where I got in, $9. Maybe that would be, say, $14 or $16, let's say. If I got in here, max loss $16. But let's say that it moved up 20 or 30 points. All right. Now I'm making $25 on top of, I'm at $25 profit. I could get out of this trade right here and get that price, because there would still be enough time left. There would be buyers out there willing to pay me that price. That's how options are priced. There are still willing buyers and sellers at all these different prices. And with something like the SPX or the S&P options, there are lots of people that are willing to pay you that price. You could get out with, say, $25. You could get out with, say, $50 if it moves up enough. That's 200% of the risk that you're taking. But let's say that it's really moving that day. It's a trending day, and it moves all the way up into your area, and it achieves the average true range, and we're here. Well, I could settle for $100 profit, which would be 4 times, or $120, which would be 5 times my the risk that I was willing to take, or I could wait until expiration and achieve up to 1,000% of my the risk that I was willing to take. Now, of course, picking the direction from the time that you get in is part of our proprietary technology that we use here at Asymmetric. And this, in fact, is totally coincident with my whole philosophy around making asymmetric bets. As a matter of fact, that's how I started the Asymmetric Advisor, this whole idea that I could put on trades. Oh, Steve was joining late, so we have Steve in here now. My whole philosophy right from the very beginning was taking asymmetric bets with the potential of making, small bets with the potential of making asymmetric returns. And so I just applied that philosophy here in the 0DTE, and I think I can also apply that in the 3D options. It's certainly how we work in the asymmetric natural resource investing part, where we invest small amounts of money and we're looking for returns of 300, 500, 1,000%. As a matter of fact, last year we averaged 350% on our returns. So why not do it here with the options too? Now, when I put on trades like this, I'm risking very little, and about 75% of the time, I'm making 100% on the amount that I'm risking. And every once in a while, about 2 times a month, I'm actually able to make 1,000% on the amount that I'm risking. So that's my inversion of risk philosophy. Now, of course, this is also predicated on, well, how do we achieve this ability to be able to pick in the right direction? Well, first of all, from the probability of touch, the probability of touch gives us that already. I mean, knowing that we have an ATR of, say, 70 in this case, and if you go back and look at the S&P over the past several weeks, that's about the ATR, the average true range of the S&P. There's almost a certainty, almost a 100%, very close to a 100% certainty that I am going to, at the very least, hit that 100% of my risk. All right. So it's obviously not 100%. And it would really depend on which way the market's going, because the market could go in the exact opposite direction. But if the market starts moving in a direction, and I'm using my analytical methods to be able to determine the direction and the magnitude of that direction, which we can to a very high degree of probability using volume profile and also linear regression, we can up those odds to about 75% certainty that we can get up to that at least that 100% return on risk, and about a 10% certainty that I can achieve the 1,000%. So 75% of the time we're going to win, and of that 75%, 10% of the time we're going to win big. The rest of the time we're going to lose super small. So hopefully that makes sense. I'm going to stop sharing again and go back to this. Let's see if there are. Alan says that toss trading fees would leave you like a net $2 on $22.50 profit. Well, let's look at that. So per contract, we're talking about $2.25. So it'd be $4.50, $9. It would be $9 round trip, right? $9 round trip, $22.50 minus $9. I mean, it's not great. It's 1350 profit. So you're absolutely right. Now you can, you're right. Well, you're right that it takes a big chunk out of it, but you're wrong that it only leaves you $2 net profit. Now, if you were to put on an iron condor, yes, I could see that. Because now you're talking about 4 contracts in and out. If you do the same strategy with the SPX or the XSP, which are the indexes, the only problem with that is that then you're contending with, if you're trading those all the time, you're contending with the pattern day trader rule. But if you can do that with either of those, then your profit will be, your commission will be a little bit less. It'll probably be on the order of maybe 1/3 or about $3, right? So in either case, if I can get 100% of the risk that I'm taking, which really means that I'm only making, say, $13.50 or 14, let's say round it off to $15, I'm still getting about 65% of profit to the amount that I'm risking, which is hugely different than the other way that you might be trading with the, the standard 0 DTE strategy, where you're only making about 5% of what you're risking. And your probability of actually being within that trade is much lower. It's only, instead of 75%, your probability of touch of being inside that trade is only about 65%. So no matter how you look at it, the odds are with you in the inversion of risk strategy versus the normal 0 DTE strategy. Plus, you're not sweating the risk. That's the big part. You are never sweating the risk. Are there any questions on that, or any comments on that statement? I'll wait. Now, there are ways that you can increase, your probabilities or your max win and loss. You can increase the spread width, which will give you a little bit more bang for your buck in terms of commissions. Obviously, just adding contracts wouldn't do that, because then you're just adding commissions. But let's say that we just change the width a little bit. And we went to a 39.45. Okay. So now instead of $4.50 in credit, I'm taking in $9 in credit. So I have a $50 max loss and a $450 max profit. So now we're maybe, obviously maybe for somebody that has only a $2,000 account, this might be a little rich for them, but I don't think so. I think that this is sort of right inside their ball game. But you see, now I can, just by increasing the width of this spread, I have diluted the cost of commissions dramatically. So now, instead of making, say, $13.50 with $9 of cost and commissions, I'm making closer to $40, $41, $42 with only $9 in commissions. Oh, can't see the screen because I turned it off. Well, I'll share that again. I'll show you. All right, so what I did was, let's take away these other spreads here. So here's the original spread that I was talking about, you know, the minimal spread. And we're risking $25 and total, you know, max risk, and the max profit is $225. If I take this spread and just make it 10 wide instead of 5 wide by changing the 39.40, the short strike, to 39.45, now I'm collecting $9 in credit. Now, the reason why this is 450, not 900, is because each point on the S&P is only worth $50, where each point on the SPX or the SPY is worth $100, right? So there's a little difference in the way they calculate the credit. But in this case, $9 equals $450 max profit, with max loss being at $50. Now I have twice as much range, twice as much profit potential, also twice as much risk, but the same amount of commission. All right. So in and out of this trade, 2 in, 2 out. Actually, is it, if you take it to expiration, first of all, you won't get the out. You'll only get the in. But let's say that I go in and out. Then my my in cost is 225 times 2, which is 450. My out cost is 450, $9. But if I make 100% on this, let's say I bring in $50, then what I've made is $41. Your probability of touch at making that $41 is about, well, somewhere between 75 and 80%. So there's that. Now, of course, that will depend on, you know, how long it takes to do that too. But that's been my experience. About a 75, I would say, let's say 70 to 80% chance that you're going to get within that $100 range within the first couple of hours of the market. That's been my experience. Sometimes you have a trending market and it goes beyond that, moves really fast. Like this past Wednesday, where the Fed spoke at 2 o'clock, and I was able to get out of one trade early on. And then another trade I held on because the price spiked huge after the Fed spoke, and I was able to get out with $100 profit. Now, this is if you're doing it, you know, starting at the market open. You could just as easily, because if they're futures, you could start this trade at 3 o'clock in the morning, say when the European market opens, and collect even more credit, and then be able to potentially get out very early. Let me give you an example of that. Filled orders, account statement. Let's see. Well, I'm not going to be able to find it. It's just too many trades. Let me give you an example. I'll just tell you what happened. On Friday, actually on Thursday morning or Thursday evening, around 11 o'clock, I put on this trade, and I put in a target for where I wanted to get in. And this is on the S&P, E-mini S&P. And it got in the trade at 2 o'clock. And then I also put in an exiting trade, you know, to get out should it achieve, say, well, it was 50 cents credit. So in other words, I made $25 in that trade. And so it got in at 2 o'clock, and then it got out at 3 o'clock, you know, when the European market opened, and there's usually some kind of bump in the market, either up or down. But because the whole market was trending up, my anticipation was that we were going up. And I made that with, unattended prior to the market opening from 2 to 3 in the morning while I was sleeping. The next morning I got up and I put on another trade. This time I did it with the XSP, and I was able to make another trade in the morning until about 11 o'clock. And that one was actually a little bit more. That was, I think, about 140% of the risk. Let's see, we'll stop sharing here. All right. So Alan, I don't know if I answered your question about the amount of cost per trade and how you can overcome that. I mean, we could also, I mean, if you're willing to take the risk, you could go to a 3-strike wide. Now the max loss would be $150. Now that doesn't mean that you have to take on or get into the trade at $150 either. You could ask for more credit in order to, as a condition to get onto that trade, and you could take that max loss down to $50 if you want. If you were anticipating that price might, say, retract first before it goes up. And this is actually one of the strategies that I use as well, particularly with volume profile. If you're looking at the movement between nodes, sometimes you can tell that there's a high probability that if it moves below one node, that it's going to go to the child node below, and you figure out where that is. That's where you're expecting to get into the trade. Just because you set the trade up doesn't mean it's going to happen. But if it does, there's a high probability that if it comes down, hits that, regresses. Now we know the S&P, for instance, at least for the past 10 years, and particularly at this time in history, every time it pulls back, it's basically a buy the dip situation. Now, I'm not saying that's going to be the way it is for eternity, but I would say for the foreseeable future, that's the way it is. It pulls back and then it sharply moves up. So we can set trades up like that with that anticipation. We don't know when it's going to happen or if it's going to happen. And if it does, it's like taking candy from a baby. And it does happen quite often. Virtually every time we come down, pull back, it sharply moves in the other direction. I would say, not virtually, but I would say probably at least 80% of the time. Very rarely does it pull back and then stay down. Sometimes we turn that into a trending day. Sometimes we turn that into just a minor move up. Sometimes it turns into this explosive move up. But the market is just moving up. I mean, I could show you that on a chart. It's kind of a no-brainer. Let's see, hold on. I'm just going to see if I can bring this in to view. Now, it hasn't been that way for the past day. It's been a couple of days. It's been going down. But for the past, I don't know. I'm going to just bring it back all the way back to, say, July of last year. And I'm going to share my screen. Hold on. All right. So here's the S&P since, let's see, going back, how far are we going back here? This is, we're going back to November. Let's try going back to, well, we can see it very clearly here. We're going up, up, up and every pullback is met with a rise, virtually every pullback. There's a couple of days where we, for a couple of days we might move down, but even within those downward movements, we have pullbacks and then sharp moves up, intraday move up. Let's say we look at the, so this is going all the way back to July of last year. I mean, we could keep on going back, but it's been basically the same situation for the past 10 years. Now, when will this stop? I don't know. I don't know if they can stop it. But even on the downward trends, we pull back and we move sharply up. These are usually intraday moves. Almost every time. There's a couple of days where, where you might lose out on this, but they're easily detectable and easily managed because we have such little risk that we're taking on. But that's essentially what we do. We pull back, we move up. We pull back, we move up. We pull back, we move up higher than before. And I don't know when this is going to stop, but I take a look at average daily or true range here that's the chart that I have down here below. I would say that the mean for a lot of this time is probably around 20 points per day, but quite often 40 and other times as high as 50 and even 60 average points per day. And that's in both directions. So a range that is double that. So when we pull back, even on an average day of average true range of 20, you could actually get a true range or pullback and move up of 40 or 50 points. All right. So how would you, you could apply the same technique to swing trading as well. As a matter of fact, with swing trading, it might be just as effective. I haven't actually tried it yet, but I'm going to. I'm going to start doing some of the back testing. And this whole idea of trading, deep in the money spreads, as opposed to deep out of the money spreads, has a lot of advantages. One is that I guess most people, when they think of options trading, they always have the predicate of taking it to expiration. But I don't think that that's the way you have to look at it. I think the way you look at it is the probability of touch. How far can we go into the performance of that stock with that type of spread on? Because if it moves in our direction to any degree, there's profit in there. And particularly with something like the S&P or any other type of highly liquid asset, you can get in and get out. TR is asking, how do you find the ATR of any stock? Well, that's pretty simple. You just, put on an average true range indicator. That's what I had in the previous chart. I just simply, and it's a standard indicator in just about any charting package. So it's either ATR or it might be called average true range. From there, you can see what the average true range is in that particular time in history, So you could look at it and say, hey, look, over the past week, we've had an average true range of somewhere around 30, 40 points. Well, then you can probably assume that you're going to have a move of 30 or 40 points, and then, create your strategy based on that kind of assumption and where you think you might have that probability of touch, and then be prepared to take the trade off well before it's time, well before it expires, because you've reached the kind of profit that you're looking for. Now, if you take this, to its logical extent, you start seeing, the potential here. If you're putting on trades that have an ultimate risk of, say, X, and you're able to achieve a profit of X or X plus or 1.5 times X on a consistent basis, what you're doing is you're making 150% on your money. But even if it's only, say, 0.5X, right, you're still making 50% on your risk, which is, even that is blowing out the expectations of the way most people are trading, trying to bring it to expiration. Now, in theory, that sounds great. I've shown that in practice, at least with the 0DTE, it works great. I don't see how this doesn't scale even to longer term trades, as so long as you have a liquid market in that particular asset. And so then that's just a matter of choosing assets that are highly liquid. If they're highly liquid, then you have enough buyers and sellers that are going to give you your price. I mean, that's what that T0 line is all based on. That's giving you the actual price that people are trading at that particular time. So if you have a stock or that has, good liquidity, when I talk about liquidity, you want to be able to look at the open interest and the volume of that stock. You want to make sure that within that strike price, you have at least a few hundred, maybe a few thousand participants in there. And the odds that you'll be able to get that price at that strike are very high. Are there any questions on that? Do you have any comments on this strategy? No. Such a quiet crowd. Well, yeah, Alan, of course, the max risk is fantastic because you don't have to sit there worrying that you're going to lose hundreds or thousands of dollars, and particularly when you know that the probability of you being able to at least duplicate the risk in terms of profit with about a 75–80% certainty is also very comforting. That you can get into a trade and that based on the probability of touch that you're probably going to at least achieve that 100% return. Now, of course, as you had mentioned before, if you're choosing the most cost-effective, thinnest possible spread, the ratio between the cost of that trade, the commission, and the actual profit might not give you, exactly what you're looking for. But just by increasing that spread by one strike, you're literally doubling that, and then decreasing the commission to profit potential fourfold. Manoj is asking, why is the net credit different when doing a vertical spread versus opening the legs separately? Not so sure that that's true. The net credit is different when doing them separately. I'd have to take a look at that, or what you're looking at specifically. But I'm not sure why that would be even a question, or why it might be a curiosity thing. I would have to take a look at that. I can't answer that right now. Let's see. TR is asking, does toss handle in the money spread at expiration the same as a butterfly, i.e. they just give you max loss with the butterfly? Yeah, and it really depends on how far you are in the money. I've found that, if there is a small difference or a small, a small difference between your long and your short spread, in other words, the max risk is very small, that they'll just wash it and then, settle it in cash. That's certainly the case with the index, SPX and XSP. They are always settled in cash. There is no assignment. And also the case with the futures. My broker actually always settles them. Once in a while, they will assign me the futures contract, but I just wait until at the end of the market because that assignment usually happens within 5 minutes. And then as soon as the futures contract comes on, I just take it off. It's not usually a problem because you've made enough profit too on the long spread to pay for it anyways. It might be that the broker just didn't, wipe it out. Most brokers have a program that goes through and just takes it off the books. If you look at the risk profile graph when doing a vertical versus a leg separately, it's different. Yeah, I'd have to take a look at that. I think it might be a distinction without a difference, but I'd have to take a look at it. We'll look at it later. All right, any other questions? Was the background soothing? All right, so going forward, I'm going to start introducing this into the 3D options service. Definitely going to make it a mainstay inside the 0DTE as it makes makes the trading dramatically more comfortable and less stressful. And in the 3D options, I think it will also do the same. We may have to look at, slightly more losses in the 3D, but the amount that we'll be winning over time will be greater as well. So, and the losses will be small. Now, in terms of long-term investing, that's something that I'd have to see. That's going to be tougher because most of the long-term investments that we make are with relatively illiquid stocks because they're new. So it might not be an option for the advisor. Alan's asking, when does the windmill farm go in that John Kerry has fought against? Yeah, I don't know. That's all craziness. But from the advisory perspective, the asymmetric advisor, we're starting to get into ESG, that's environmental, sustainable, and governance oriented stocks in a great deal, only because there is massive investment going into there. You don't have to be a believer or a non-believer to want to make money in that area. So I would imagine that they're going to try their damnedest to throw as much money as they possibly can at it. Whether or not that's going to turn into anything, I don't know. But I think that there is definitely money to be made in the market. And who knows, with enough money thrown at it, maybe they'll come up with some advancements. And of course, we'll all pay for it in our taxes. Trying not to get political here. All right. That's all I've got for today. I hope this was useful. And I hope you have a great weekend. Thursday night, we'll be looking for a 0DTE trade for Monday. If we don't find it Thursday night, then we'll just reconvene on Monday morning and put on a trade then. If you're interested in the 0DTE, let me know, or go to the front page of the Asymmetric Advisor, sign up. I think that you would enjoy it. It's a great way to make a little bit more consistent income throughout, through a month's time, because you have a lot more opportunities. 3 a week, 4 weeks, a little over 4 weeks in a month. So a lot more opportunities. All right. Thank you. Have a great weekend.